Following the collapse of Silicon Valley, Signature, and First Republic banks, fear of a collapse in the commercial real estate market has been top of mind. Elon Musk is the most recent prominent voice to express concern, saying in a tweet, commercial real estate is melting down fast. Now, a report from data provider Trepp says that $1.5 trillion in commercial debt could be coming due in the next few years, adding to the pressure. Joining us now with more on this is Brian Pascus, reporter at the Commercial Observer, which covers real estate. So you're sitting squarely in the midst of this. And the issue is, as I understand it, is that a lot of loans that people take out, that companies take out, investors take out for commercial real estate are interest only or balloon loans.
Sure.
And so when it comes time to actually pay off the loan, if conditions have changed, if you can't sell your property, if you can't refinance, et cetera, you have a problem. How big is the problem?
It's a big problem. I mean, ultimately, commercial real estate is super interest rate sensitive. And what we've seen is the highest interest rate increase in 40 years engineered by the Federal Reserve. And for the last 15 years, commercial real estate and many other businesses were relatively addicted to low interest rates, and they made their decisions accordingly. So what we had was a recent article in the Wall Street Journal that showed, today 85% of all commercial mortgage-backed security loans are interest-only loans, meaning they were expected to only pay the interest and then they pay the principal off at the end. Well, that equation is radically different than it was in 2010 when 15% of all commercial mortgage-backed security loans were interest-only loans. So it shows you how dependent on low interest rates the sponsors were, the investors were, and the owner of these buildings were. So it's an issue, but I think people need to recognize and take a step back. Commercial real estate is a large industry. I mean, this is an industry that involves industrial storage buildings, it involves multifamily apartments, it involves hospitality, hotels.
I think people picture only office buildings now.
It's not only office buildings. There's office buildings are where the pain is. Retail has seen some pain with e-commerce growing, but there's parts of retail that are becoming, more attractive. But yes, offices are in trouble. There's not much we can do about it, but ultimately, I think the business will evolve and get through it.
One of the other major parts of this that I'm admittedly learning more about is the upcoming maturity wall. What do people need to know about that as it relates to commercial real estate?
So there's 1.5 trillion of maturities on these commercial real estate loans due by the end of 2025. So basically, picture like 500 billion a year is going to need to be paid off, over the next 3 years. And ultimately, the sponsors are going to need to find ways to get equity or debt into their capital stacks to pay off these loans. And what we could count on is, as the banks have kind of pulled back recently with the regional banking crisis, there likely will be more private equity partners entering into the capital stacks of these commercial real estate loans to help these maturities and to get this wall paid off. But not everyone's going to get that money. These are tough negotiations, and some people, some sponsors, some buildings will go under. They'll have to be sent into foreclosure or special servicing. The banks might take over the buildings themselves. There's going to be winners and losers, as there always are in a capitalistic system. But there will be some pain, obviously, because as we said, the interest rate equation changed, and that has caused a lot of disruption and distress in the commercial real estate market.
How much can we tell in advance who the losers are going to be? There's been a lot of discussion about this, about where this stuff is held.
So I think we're already seeing where some losers are, and this is in the public office REIT sector. So you're seeing a lot of headlines about Vornado, SL Green. Their stocks are down, 60, 50, 80%, or if not 80%, 50, 60% on the year. And this is because these are office-dependent companies that they made the bet. It was a great bet for decades that people will go into work 5 days a week, that these buildings will continue to always have value. They're going to have good rents. They're going to have good tenants that will be able to pay off hundreds of billions of dollars of commercial real estate debt that they take out to purchase these big buildings. Well, now New York City's seeing maybe 56% of employees on a given day of the week come into the office to work. That's not going to
One of those companies owns this very building in which we are sitting right now.
Yeah, any building you could be in could potentially be in a distressed situation. But that doesn't necessarily mean, we're all going to be emptied out in the street.
Right.
You're just going to have to find solutions. You have to find, equity partners to, fill the money you owe on your loan. That's just what's going to have.
Even for retailers, the construct of how much square footage they want to operate in their own real estate footprint is changing dramatically based on how consumers are engaging with them. What does that kind of spell out as well in the commercial real estate environment going forward?
Well, retail's been under a lot of change and has been, experiencing a metamorphosis since really the turn of the century. We remember, buying eBay 22 years ago, and now Amazon's growing. And what you're going to see, though, is that there's always going to be room for small business in this economy. You might have the Bed Baths and Beyonds go under. You might see JCPenney's, J. Crew. No longer are people going to be shopping at the malls with these anchor tenants into the future. This isn't 1984 where we're spending all of our day at the mall. We're mostly spending it online. But there is still always a place in most American cities where you're going to want to go out and buy that specialty store. You're going to want to go to, the store that sells furniture because you want to sit in it, you want to buy it, you want to know what it's like. You want to try on clothes, in person. So there's always going to be room for that. It's just not going to be what it was for most of our lives that we've known.
Brian, finally, I want to ask you, you guys have a big conference in the fall, right, that looks at the REIT business.
Yeah.
And I imagine the crux of it is going to be some of the same questions that we're talking about right now.
Yes, well, that's going to be specifically focused on real estate and investment trusts, the REITs. Those are modeled on mutual funds, and they are basically companies, corporations that purchase, invest, hold on to large portfolios of real estate assets. And the REIT industry is very large. It's very diverse. It encompasses everything from the 5 major food groups of commercial real estate to data storage to hospitals to even timberland. Cutting down trees and storing that. There's
cell
REITs
towers
for that.
too.
Cell towers.
Yeah.
The REITs are huge. They're everywhere. This building we're in was likely part of a REIT portfolio. So Commercial Observer is going to be hosting a large conference on October 17th. I'll be there covering it. We will, hopefully be, educating the public on the importance of REITs and how, wide a pool they have in our economy.
Looking forward to much more of that timely information coming forward from you and the team. Brian Pascus, who is the Commercial Observer reporter, joining us here in studio today.
Thanks for having me, guys.
Absolutely.